that stock is actually holding up 5%. But let's welcome on board Ashi Anand from Valcreate Investment and talk about what he's making of the market structure and the texture right now. Ashi, hi, afternoon. Welcome to ET. Good to have you on the show. Just wanted to understand your overall, thought on the market right now. While FI inflows have been intact for us, a lot of sectoral churn at play, but a lot of overvalued pockets as well.
Thanks a lot. Thanks for having me. Broadly, in terms of the markets, right, we've seen a fairly good rally in the midst of kind of a fair amount of concerns globally, right? You've got global headwinds in terms of economic growth. Valuations are a bit high, mid and small caps are a bit expensive. Consumption has also been relatively weak. Now, what's been driving this rally? I think clearly the biggest driver is the fact that inflation and interest rates have clearly peaked. You have seen the RWA pausing, and this was one of the biggest headwinds for the market over the last many months, right? So with that kind of coming down, and importantly, fund flows having turned positive. Last year, you had almost $17 billion outflows in terms of FIs. This has shifted to 4.4 billion positive in the current year. This is kind of driven by, if you're just looking at India from a global context, you are really seeing India really starting to outshine other global markets. China clearly has its areas of weakness, and I think you're starting to see flows move from China and Asia towards India, towards a very strong longer term growth trajectory. So broadly, the way we look at markets is we don't expect a sustained bull market until some of the global headwinds, some of the kind of even Indian headwinds, consumption is a bit weak in India, until these don't kind of peter down, we don't see a sustained bull market developing. That said, with interest rates and interest rate and inflation having peaked, we also kind of, so the broad idea is that markets could remain range bound over the coming year.
Okay, range bound over the near term. That's the view coming in. But just quickly wanted your take, Ashi, if you track these, companies closely. PVR, of course, is one stock which is gaining around 4 to 5% higher. If you maybe look at the entire consumer discretionary theme, what's happening with respect to the QSR space, etc., anything that you'd like?
So actually, within kind of the consumer theme, right? As in consumer is a space that we do find very expensive. There are a few pockets of growth, a few pockets of value available in certain kind of companies. So we like ITC, we like Jyoti. When it comes to the QSR space, our preferred way to actually play it is via a company like Zomato. We see a lot of long-term value in digital platforms across the board, and so growth from consumer growth longer term in India is very clearly one of the most interesting plays. We prefer playing that via the digital platform themes. We believe this to be one of the most interesting kind of ways to play the consumer theme in India. That said, within kind of QSR, things are a little mixed, right? So certain companies like Jubilant, you have issues around milk prices and raw material prices impacting growth. So it is a little kind of mixed in terms of consumption. Given how high valuations are, we tend to be very picky and very choosy in terms of how we look at playing this theme.
Actually, since you did talk about the digital platform space, I must talk to you about the likes of an India Mart, for instance. Excellent set of numbers. We are seeing the stock as well on a tear today. And then, of course, if you've done any case study on a Paytm or a PB FinTech, where at least in terms of the stock price movement, the worst seems to be behind. But I guess with these case studies, it's more about profitability. No one's denying their long term potential, but it's about when do you buy the stock and when do you get into it.
So we actually at Valcreate, we launched a pure play digital strategy in February this year, pretty much close to when the markets were at the bottom. We've done very detailed work on the space, and I think there's a big disconnect in terms of the way listed market investors are viewing digital platforms. If you understand how digital platforms work, uh, all digital platforms globally and domestically have to go through four distinct stages of business evolution. In stage one and stage two, you're really just focusing on building out your platform, trying to achieve a couple of key factors. One is becoming one of the dominant players in that particular niche. Secondly, trying to change user behavior to so that they move away from traditional forms of interaction towards the platform being the de facto. Once you have achieved these two core goals, you can actually reduce a lot of spends that are directly linked towards trying to drive user behavior. And I'm specifically talking about discounts. These can actually be reduced very, very substantially. And as you enter stage three, your consumers, they are no viable options any longer. You become a dominant player and users have gotten used to interacting on your platform. Reduction of discounts and the introduction of certain fees will not lead to users moving away when there are no other alternatives. Our studies have shown that over 50 to 60% of revenues account are essentially related to such one-off costs. And as these platforms mature, uh, the shift towards profitability can actually be very, very rapid. You're already seeing this in terms of numbers. So if you're just looking at post listing, Zomato's food adjusted EBITDA has moved from minus 18 to 5. Paytm's adjusted EBITDA has moved from minus 63% to 5%. Policy Bazaar from minus 23 to 3%. These are actually, if you look at, if you understand the core profitability of these businesses, they're actually highly profitable. It's just a question of what stage of business evolution you are. As you get listed, you're typically entering stage three, which is monetization. You're already starting to see these numbers. And according to us, as you go into FY 25, 26, 27, these companies are going to surprise all analysts, most people on the street dramatically in terms of just how high the inherent profitability of this business is. And that's essentially the call we are taking at Valkyrie.
That's an interesting take, but you know what? Just hold that thought. There's